Sure.
Welcome to the Know Your Numbers podcast, Better Books broadcast with Chris McCormick. I have a very special guest today in Tim Vest. He is the managing director of Harvest Properties Group. He's also a technology manager, and he was one of the first real estate professionals that I connected with via LinkedIn. So I do appreciate all that he's provided in the form of conversations and insight over LinkedIn. But Tim, welcome to the show. I gave you a little bit of an introduction, but maybe you could introduce yourself a little bit more, but really appreciate you being here.
Yeah. Hey, Chris, thanks for having me on, man. Really appreciate it. And yeah, I guess it has been a while since we connected on LinkedIn. But so Tim Vest, Harvest Properties Group. I've been out of the Charlotte, North Carolina area. I've been doing real estate on and off or in some fashion since 2006. Not really off. The only times I really took off is when I was transitioning into other spaces within real estate. But yeah, started with land development back in 2006, transitioned into fix and flips and single family rentals in around 2009. And then I guess about 2018, exited that space, was looking for a place to go where I wanted to go next in real estate, and looked at a lot of things and ended up in multifamily. And that's actually transitioning a little now, definitely staying in multifamily, but starting to add in mixed use as well, where there is multifamily on the property, but probably a retail element as well. And just kind of just naturally fell into that. We, as we started to take down property, sometimes in city centers, not in the suburbs, we started to get presented with opportunities where there was retail on the ground floor. And, a lot of people have been kind of scared away from that in the last 18 months. But there's actually, at least me and my partners think, some pretty good opportunity there. And then, it's anchored. We look at it kind of the other way. It's anchored by the multifamily rather than anchored by the retail. So it's an opportunity to kind of get retail at kind of a discount right now and still have that kind of guaranteed cash flow with the multifamily that we're familiar with. So again, nice to be here. Thanks for having me on.
Of course. Well, that's a good place to start. And I didn't realize that. I mean, you have experience in a range of industries, and that's where I was going to go. But if you don't mind diving a little bit deeper into what you're currently doing. So do you have like current investments set up where you're doing it in that way? And how has that been advantageous? How has it changed your outlook on investing, if at all?
Yeah. So you're asking if I have a fund of investors or if I'm investing myself.
Does your fund have current holdings that are retail and multifamily, and how has that benefited you?
So Harvest Properties Group right now does not actually have any retail. We are getting ready to take down our first two properties in that space. One probably in the Richmond market where we already have some multifamily units, and another in the Columbia, South Carolina market where we have some multifamily and are expanding very rapidly in the Columbia area. We currently have 4 other properties under contract right now in Columbia.
Wow.
So yeah.
And you specialize mainly in the big apartment complexes, right?
We have properties in the 100+ space. However, in the last year, once kind of institutional and much bigger companies started to come back into the space, that area became so kind of overheated, if you will, that we adjusted our business plan a little bit and we started going after the 20 to 70 unit space very aggressively. And even recently, we are starting to look at multifamily even smaller than that, where it makes sense, particularly and specifically in the student housing play. That's another area that kind of took a little bit of hit during COVID. But prior to COVID was on like a ridiculously accelerated trajectory,
Yep.
and you're starting to see that come back. And so that's one place where, hey, if we have multifamily experience, let's look at the student housing area as well. So it's a way to take our business model and our plan and our experience with multifamily and just diversify it across multifamily, if you will.
Yep.
So yeah,
That's cool. And how do you, so 20 to 70 units, that there's a number, and that jumps out at me. And so I'm curious how you find that niche. I know you said the larger ones are kind of overpopulated with the big wigs, but why 20 to 70? Why does that make sense? And how did you come about that?
yeah. So 20 to 70 plus or minus 10,
Right. Yeah.
yeah. So that's just kind of so when you go search for properties, when you're sourcing them off market, a lot of time the systems are set up to only look for, there's a minimum number of units that it will
Okay.
search for a lot of times. So we kind of landed there with that. And then two, based on some of our analysis, what we noticed as we were going through those lists, when we were pulling those lists of properties, what we noticed is those tend to be in that 20 to 70 number. Those tend to be owned by more, quote unquote, people call it mom and pop,
Right.
less institutional, less larger companies, more, you and me,
Yep.
type of folks. So that's another reason like we went after that is those are easier to get, not easier, but it's more effective to get them direct to seller, and go after that size asset. So that's kind of how we landed there. But again, if a deal makes sense, I'll look at a quad, I'll look at a
Right. Yeah.
fiveplex.
Yeah.
And so as long as the numbers are there, we typically take a look at it.
Okay. I gotcha.
Yeah.
And what are some of those numbers that you look for? I know. Go ahead. You can take that one away.
Yeah, so it kind of depends based on the type of asset. So in a 20
Yeah.
plus, we're looking for 9-10% cash on cash return minimum.
Yeah.
A 2x equity multiple within a 5-year time period, kind of
Okay.
that standard number a lot of folks are looking at.
Yeah.
So in that 20 to 70, that's kind of what we look at.
Mhm.
When we get into the smaller properties, if like for instance, we have a fiveplex under contract right now.
Okay.
We probably would not gone after a fiveplex for an 8% cash on cash and a 2x.
Right.
But this is actually a pretty heavy lift. But it's not a heavy lift across 50 units.
Yeah.
So it's something that we can turn around in say 3-4 months, and within 18 months we're looking at 18-20% cash on cash and a 3.5 equity multiple
Right.
to the investor. So the project the project itself is actually higher than that. That's the
Wow.
investor return. Yeah.
Okay.
So and we have some investment partners who, if we call one guy up and we're like, hey, we need 200,000 to do this, and we
Yeah.
tell him those returns, he's like, I want every bit of it. I'm in. It's mine.
Yeah.
So that's why we go after that.
Right.
And then two, we only do that we don't do that all over the country. We find like a specific market and we go after it in that market. So you get some economies of scale.
Yeah.
Because that's one of the reasons people go after larger properties, right? Is I can do a 70 unit in Texas and a 100 unit in Florida and an 80 unit in North Carolina. It's harder to do that if you're 4 unit here and 5 unit there.
Yeah.
Here we go into like a specific market and we say, I'm going to take all these quads on this entire block, right? All within a half mile of each other.
Wow.
So you almost kind of deploy that large asset strategy to different properties, but all so close to each other that you can kind of handle them like a larger apartment complex.
Wow. Yeah, that's crazy, because I was kind of trying to wrap my head around like how you go about finding the deals and the values. And so what I'm picking up there is that it might not even be a big property right away, but it's the vision that you kind of see it for.
Yeah, it's the vision for sure. Yeah, that's been one of the biggest things for me, and that's kind of
Mhm.
where I tend to add value to, the partnership is, I have a really awesome business partner, Robert Musso, who's
Yep.
amazing at kind of like marketing and sales, and I mean he's done it all,
Yeah.
from development to heavy lifts to single family to multifamily. But he really excels in that kind of marketing and sales and strategy space. And
Hmm.
where I do really well is hitting the ground, figuring out markets, like walking a property and coming up with an idea for a business plan.
Yep.
So we kind of play off each other that way. Um, and then we keep each other honest on both sides of the house. So yeah.
Yeah. That's cool. And then on that note, like how do you come up with the numbers? Like selling price, buying price, the return. It's a lot of estimates and analysis. Is there any system that you have in place that helps?
Yeah. So a couple of different ways. Like one is, all the market analysis, city
Mm.
data, CoStar, Reonomy,
Yeah.
you name it, apartments.com, going out there, just kind of identifying that rotometer. Um, and then all the market analysis that you see, like this is the hot market, this is, and then for me, and especially in the North and South Carolina space, it's the fact that I've just lived here my entire life and I just know the areas really well.
Yep.
Um, and then so I combine that with actually getting to a point, once I identify an area where we might want to take a look,
Hmm.
then I go to that area and
Okay.
I start to meet with property managers. I start to meet with brokers. I start to meet with other people who own assets in the area and work with them, and just kind of take them to dinner, take them to lunch, have coffee with them, and just pick their brains. Um, for instance, this one market that I'm talking about where we have the fiveplex, I went into that place thinking, hey, rents are, a two bedroom is going to rent for $1,200 is
Hmm.
kind of where I went into it as. And as I started meeting with some people in the area, they were like, well, in general, in the city, yes. However, if you focus on this little pocket, and he gave me zip codes, and he was like, this pocket, he was like, those same two bedrooms can get you 1,600. And the price per door to buy them really isn't that different. So
Yep.
your all in cost is the same, but you're getting $400 more a month per unit.
Right.
So I wouldn't have known that had I not gone and talked to somebody who's actually doing it currently in
Hmm.
that area. So it's a mix of things,
Yep.
and I find it really hard. Like I'm a technology guy.
Yep.
I love systems.
Right.
I love sitting behind my computer trying to figure things out. But even with that, I find it very hard to replace the final step of it, which is showing up on site in person and
Hmm.
talking to people that are actually living and doing it currently.
Yeah.
Um, you know,
Yeah. And that's funny because I did want to touch upon that. And I know from our previous conversations, you mentioned you tend to have an introverted side to you, and you like to spend Friday nights on your own, and I'm the same way kind of thing. So I'm wondering
yeah.
like how you overcame that that mindset and how relationships have served you the most and what you've learned from that.
Yeah, so I'm definitely introverted.
Yeah.
And part of that was linking up with a mentor. I
Hmm.
think I've mentioned this a couple of times. So when I was trying to get in the multifamily space, I reached out to a couple of different mentors, and I landed with a guy named Mike Ely out of
Okay.
Cincinnati.
Yep.
And if you've never met Mike or never talked to Mike, Mike has an incredible personality. He
Yeah.
he can talk to anybody. Um, and I'm not that way.
Yeah.
Uh, but just like having Mike there to kind of say, it's just a conversation, man. It's just
Hmm.
a conversation. Don't make it more than it is. It's just a person talking to a person, and it's a conversation. So I started to realize that. And then what I actually realized was, one on one, I'm actually pretty comfortable.
Hmm.
What I don't like is getting up in front of like 50 people and talking.
Yeah.
But one on one, I'm actually pretty comfortable.
Right.
and and then there's just a part of that, like you actually just have to push yourself and make yourself do it, right?
Yeah.
So there is an aspect of that. Mike could tell me all the things in the world that make sense, but I
Mhm.
still have to go out and just make myself do it. You know?
Right. Yeah. Action, and with action brings clarity. That's
Yeah,
what I
yeah. And
say.
then hey, guess what? There absolutely were days where you just pick up the phone and you're like, man, I really don't want to have this phone call.
Yeah.
But then you make yourself do it. You're like, you know what? I'm just going to do it. If I fall flat on my face, who cares? I don't know this person.
Right.
I don't know them. If they have a bad impression of me after this phone call, it's all
Uh,
right. And just going at it and doing it. And then once you get off the call, you're like, that really wasn't that hard.
right.
So, like
That's
you said,
funny.
action.
Yeah. No, I think I had a similar feeling when I first called you, or when you called me, if I'm being honest. So
Yeah.
that's cool. And Tim, again, I appreciate your time. I know you got stuff, and we both have stuff, but one thing that I want to touch upon before we close is your history with real estate, and the different asset classes that you've touched upon, from land to I think single families as well, and then you finally got into the multifamily. What has served you most, and what kind of do you see as being a consistent key in each industry, and what are some of the lessons learned from each and every one of those?
Yeah. What has served me well, and I can go back to when I first started in 2006 with land. What has served me well is honestly that experience. That experience went really, really well for about 18 months.
Mhm.
And then, if you
Yeah.
go 2006 and go out 18 months, we all hit 2008. And we
Right.
all know what happened in 2007 through 2009. So around 2008, that experience went really, really bad.
Mm.
And looking back on that, I noticed two things, which was exit strategies and a mentor.
Hmm.
Um, I had nobody at the time to tell me, you should probably look at these things.
Right.
And, a mentor at that time would have been crucial and probably helped me save a lot of money that I lost.
Yeah.
Um, my own money that I lost. Fortunately, I didn't have investors at the time, so it was just
Right.
my money.
Right.
And then, so a mentor and multiple exit strategies, and those, regardless of the type of asset, whether it be land, single family, fix and flips, you name it,
Yeah.
multifamily, retail, as long as you have those, your chances for success are a lot higher. So now, one of the things I just make it a priority to do is, hey, you know what? Guess what? I'm making X amount per year doing this kind of thing. I'm going to take 10 or 15% of that. I'm going to set it aside,
Mm.
and that's for education and mentorship.
Okay.
Um, a lot of people kind of look down on masterminds sometimes
Mhm.
because they feel like it's like, whatever it is. I look at masterminds like I don't just go join any of them. I'm very, very selective with the ones I join.
Yeah.
But the ones I join, I'm specifically looking for mentorship and networking
Mm.
out of the mastermind, because I'm looking for the leader to be my mentor, but at the same time I'm looking for other people in the network who have experience doing something I might want to do, and they may have some knowledge that I don't have.
Yeah.
So I look at it as an investment every year in education. And then again, like I said, exit strategies. We don't go into anything now that doesn't have at least 3 exit strategies associated with it.
Yeah.
So
And so, when you say exit strategies, what are some of the ones that you look for, and what's like one that might be on top of your mind?
well, there's always the nirvana, right? Like everybody wants to, I want to hold it for 5 years.
Yeah.
I want to
Yeah.
2x my money, and I'm going to do 12% cash on cash. Okay,
Hmm.
cool. That's great. That's one exit strategy. Another exit strategy is, hey, what happens if the market turns bad? Is one of your exit strategies literally buy and hold?
Mm.
Like, can you ride out the market? So we
Yep.
don't buy anything that doesn't give us the ability to ride out, a downturn.
Okay. Hmm.
Um, and then sometimes we go into things like with our downtown Richmond property. We have like 3 nirvanas on that one, where it could be a potential condo conversion at the end, where we don't even sell it as a traditional multifamily property. that we, go in, put an HOA in place, convert those to condos and sell them off individually. So, that's the kind of things that we look
Yeah.
for.
There's some creativity to it, and it's about that vision, right?
Yeah. And always being ready to, hey, we know we can survive here, right?
Yeah.
Like I
Yeah.
know we can survive here. We can make our investors pretty happy here.
Hmm.
But then there's all these other things above and beyond it that would be opportunities that, hey, 2 years down the road, we'll keep our eyes on the market and we'll pivot into a condo strategy, or hey, just like some people have done in this last year. Hey, I know we said we were going to hold this for 5 years, but guess what? Cap rates have decompressed so much that we can actually 2x you or 1.8x you in like 12 months. So we're just going to do that.
Wow.
And that's I don't think you're going to hear many investors complain about that.
Right. Wow, that's great. Um, One last thing before I close with another question, but how do you account for the potential of a downturn? You say you lay it out like we can make it through this tough time. How do you know like what a tough time entails?
Yeah, so always keeping your eye on trends in the market.
Hmm.
Because one of the things up until COVID, one of the things people always said about multifamily was multifamily weathers storms, right?
Yeah.
Like even if the value of your property drops, rents don't tend to drop. Rents
Hmm.
don't tend to decline.
Yeah.
So, like in 2008 and 2009, multifamily properties, rents still stayed where they were in the B and C class assets. Now
Right.
A's suffered, right?
Hmm.
But B and C stayed. And if those properties were cash flowing going into 2008 and 9, they were still cash flowing after that. Now, COVID taught us something a little bit different, right? C class has always been seen as like kind of the bulletproof asset class.
Yeah.
C class really suffered in COVID
Okay.
because the people who had white collar jobs it was much easier for white collar jobs to go home
Hmm.
and work from home.
Right.
Blue collar jobs that rely on a manufacturing facility or for you to be in person, those suffered. So, in those C and lower B class assets where a lot of like blue collar workers
Yeah.
live, those suffered. Now you saw a lot of delinquency and stuff. So, that's one of the things that we kind of pivot our business strategy on is, hey, how do we account for another situation like COVID?
Hmm.
And one of the things that you look at is, hey, we need to make sure that, hey, even a C class property needs to have, for example, some B class aspects to it,
Hmm.
so that you can market to a kind of a slightly different tenant base. So that's one of the things that we've noticed, and we've adjusted our strategy a little bit on that. So where we would have, typically gone after down this path during our business model, we've kind of brought our business model back in to include, B and C class asset
I got you.
amenities. Yep.
Wow, that's cool. Well, thank you for sharing that, and thank you again for your time. We're coming up on 30 minutes, so I will close with just two questions, maybe one, if depending on how long the answer is. But if you weren't in real estate, where would you be? And then I guess on a second note, personal finance wise, or wealth building tips. Any tips for somebody outside of real estate that you might be looking into, or something just that somebody can bounce off of? Go ahead with whatever you think.
Yeah. No worries. So if I wasn't in real estate, where would I be besides say technology?
Yeah.
If I was going to pivot out of technology into something else that wasn't real estate, it'd probably be something in healthcare and fitness space. I have
Okay.
a passion for that.
Right.
And my off to the side, I do a lot of stuff with that as well,
Hmm.
just personally. So that's probably where I would have gone or would go. And who knows, maybe 10 years from now, that's where I do go.
Yeah.
Um, but and then wealth building tips. The biggest thing I would say is, one of the things I see a lot with investors is I don't have enough, right? I
Mm,
don't have enough to do something.
right.
um and I don't agree with that. Like any amount's enough to start. Like
Yeah.
maybe it's not enough to get into a 25 or $50,000 syndication,
Hmm.
but it is enough to go out to a place like Crowd Street or something like that. and invest $500 or $1,000 into real estate.
Right.
Get into a REIT or
Yep.
whatever. But don't limit yourself to just stocks and bonds and things like that. If you have some amount of money, there are other avenues for you to invest your money that have really, really strong wealth building aspects to them. So just don't limit yourself. Seek out some information and educate yourself on what's available.
That's awesome, Tim. Well, thank you very much. I appreciate your wisdom and insight, and this has been a pleasure. I'm sure
Yeah.
we'll be
Yeah.
touching base soon, but thank you, man. Appreciate you. Of
Yeah. Thanks, Chris. Thanks for having me on, man.
course. All right. I'll talk to you soon.
All right, bud.